Good morning, good afternoon, or good evening, depending on your perspective on the world. And welcome to the Coach's Corner. Just fix this real quick. There we go. A little bit of light on me. All right. Joining from the beach. Now, not quite, but I'm pretty close by. There used to be my view at my old condo. The view the guys are getting in there. I moved away from the beach, but I'm still quite close by. But anyway, we'll go ahead and get started here. Just like to welcome everybody here for the Coach's Corner. You like the bow tie? Thank you. Yeah. So I decided to get changed and decided to wear the bow tie today. So bow tie Brandon's back. I like him. I like him a lot. Like I said, it's fun to tie him, and not a lot of people have these, so it's kind of a different look. And I think I can pull it off. I don't know. Some people make fun of me. People say I remind them of Tucker Carlson. Anyway, but that's not me for sure. Anyway. So we'll go ahead and get started here, and I should be sharing my desktop. Let me just make sure. Yeah, I am. Okay, cool. So we see my Coach's Corner there, my other bow tie. That's from a few years ago. I've been wearing these for quite some time. And getting into this, just need to remind everybody that we're not registered broker dealers or investment advisors. I'm going to look at a lot of different securities here. Excuse me, because I do, it doesn't mean that I'm telling you to buy, sell, or hold those securities. I'm not telling you to trade them. Can you vote with a bow tie? Sure. I've got tons of them. If you don't like this one, I wore my free preview day the other day on Wednesday. I did a bull and bear bow tie. It was kind of cool. This one is a flowered one my wife likes. But anyway, any mention of a particular security is not a recommendation, and it's not telling you that's specific for anyone in particular. All trading does involve risk of loss, and this will always be the situation no matter what we do to limit risk. No, my wife did not make this. I bought it from a small company in Vermont called Bow Ties Ltd, BAU. So it's Bow, it's BEAU Ties Ltd. You find them on Facebook, Instagram, all that good stuff. But yeah, so they're handmade, actually. Every single one of these I buy, they're handmade up in Vermont, American company. So it's kind of cool supporting small companies. Actually do have a couple ties that were made by her aunt, believe it or not, by hand. So, all right. Anyway, continuing on here, you can see that we're here every week for Coach's Corner. We kind of rotate between myself, Tony, and Ryan, and Power Hour on Monday. That's Rob that does that. And you can join us for any of those free online workshops every week. Love to have you there. We have some premium online workshops. We're doing the Seasonality of Futures. I did that earlier today. But we got some patterns in a flash coming up, inner circles coming up. I'm doing that one. We got Trading You and a few other things you can get involved with if you're interested. I'm actually going to talk a little bit about one of the other programs. Yeah, it was E-Mini Think Tank that I did the seasonal, but I'm also doing a little bit with you guys right now too. It was recorded for them earlier, a little more intense than what I'm going to get into here. But the E-Mini Think Tank is a program that I run, and we do a live trading session every Monday, Wednesday, and Friday from 9 a.m. to 11 a.m. And we did the bonus session on a Friday too. So if you're in there, you get a chance to go check that out. It's kind of fun to do that. When I go into that E-Mini Think Tank, we go back here and E-Mini Think Tank, it's not just the live sessions. Since you brought it up, it's actually also a lot of education. There's a lot of bonus materials that I put out that are educational. Anything from how to find zones to choosing the right targets. How to use certain indicators, options on futures. If you ever wondered about that, I did a whole session on that and recorded it. And there's also documentation that accompanies all of those live classes. So you go down here, you see other strategy. There's a lot of stuff there. Yeah, you never saw me talk about the options. I did a full session, a bonus session on options on futures. So yeah, definitely get your butt back in there and check it out. But there's documentation, like I said, to kind of accompany all of this to help you understand how to use these tools that you can learn on your own. There's a lot of self-paced education here, as well as, we do all the trades, and we have the class recordings of the trades as well. So you can go back and rewatch those and look at some of the swing trades if you missed the live trades. So anyway, I think it's a pretty good program. And thank you, Kevin. Kevin saying, join E-Mini Think Tank. Brand's an awesome teacher. He knows his stuff. Well, thank you very much. So Pat saying agreed. Well, thank you. So anyway, since I know a bunch of stuff, I'd like to share that with you today. So might as well jump into that. We're going to talk about, like I said, seasonality of the markets. And with the seasonality of the markets, basically what we're doing is trying to figure out when are the best times to trade a particular security. And what happens with most securities is that they go through a seasonality, meaning you have spring. We go back to a chart here, actually. They have spring, and this, by the way, is not calendar necessarily. And, it doesn't mean that your spring is in March every year. Okay. Spring for the security is when the security is rising slightly. Summer is the full blown bull market. We're just moving straight up and seeing lots of strength in the markets there. Then you come into fall, which is where the market's starting to get a little top heavy and possibly pulling back to the downside just a little bit. I'm going to get a little casual here, roll my sleeves up. This is I'm at the beach, right? Anyway, I missed that picture. Like I said, that used to be my view every day. The problem was that building underwent renovations. And when they did the renovations, it was noise every single day. So we moved out, got a little bit more quiet. Yeah, you guys remember that? Anyway, with the fall and then seasonality is when the prices are starting to move a bit to the downside. We're starting to get the top selling off a little bit. And then the winter is the full blown downtrend. Yeah, I had bad internet too on the beach. So I got high-speed internet here that upgraded, and it's a lot quieter and better. I still have a water view. No, I moved because I was getting a little too crowded. Spring break was absolutely nuts. The traffic was insane. It took way too long to get in and out of the condo because it was on an island. If you know anything about Fort Lauderdale Beach is actually an island. There's only 2 bridges to get onto the island at either end of the island. And I mean, there's still a road that keeps going as well. But yeah, 17th Street and then Sunrise Boulevard are the 2. So there's 2 lanes each way, and it just gets packed with tourists and even the locals. So they have way too many people there crowding it up, unfortunately. So that's why I moved. But I'm still close by. I'm in a place called Wilton Manors, and I actually live right on the waterway. So we go kayaking whenever we want. It's kind of nice. Anyway, I digress. I'm going off the topic here. So we'll take a look and see what we were talking about. Yeah, exactly. My dogs play with the lizards. But what we're going to be talking about is seasonality. And again, it could be individual securities or something called spreads, which I'll explain a little bit about as well. So when it comes to seasonality, like I was saying, you're looking at longer terms in the markets, not just this intraday stuff. Intraday seasonality doesn't even come into play. It's not a factor. So let me do ES continuous. There we go. And I'll clean this chart up. Yeah, pretty much you're going to be looking at 4-hour charts and higher for the most part. Yeah, you're not looking at small time frames. So for instance, here we went from summer to winter right away there and then back to summer almost. I guess you consider this rise is spring, then we're in the full-blown summer there. We're moving very strong to the upside. Eventually we'll hit autumn where things start to get toppy and we start to turn down. And then you get the bear market of winter. Now that could take some time. It doesn't have to happen right away, but we're looking at longer term here. And these cycles even occur on a regular basis intra-year, not just over the whole calendar year, but you can get smaller versions of this as well. So it's good to know this because it increases your probability for success. If you are getting ready to do a swing trade, for instance, and you're going to be going long on a security for the next few weeks or even months, it's good to know that seasonally for the last 15 years, every single year at that time, the prices would rise. That gives you a higher probability of success. Now, the big drawdown actually, let's do it this way first. We'll go ahead and list, seasonality. And, advantages. Number 1, you have consistent signals. So you get an idea of when it's good to trade something or when it's not good to trade something or when it's good to trade in the opposite direction. Because once more, these signals happen on a regular basis every single year. And, they're followed by major institutions. They're pretty reliable because if they're followed by the major institutions, those institutions are going to trade based on those seasonal signals, and they're going to cause prices to move in a particular direction, one direction or the other. Sorry, Pascal just came up here. Come here. You want to come up? You want to say hi? No, he doesn't want to. He's just staring at me like, what are you doing? He's trying to play with his lizards. So you get these consistent signals, okay? One of the drawbacks to this, I'm trying to think of what else is, let him teach. He'd probably do better, right? Come here. Lucy's coming up. She's the one who usually likes to jump on my lap. It's Pascal. There you go, buddy. You say hi with a floppy ear? All right. No, he's not into it. He's looking around. Lucy's trying to jump into my lap though. She's the one who likes to come up here. Anyway, thanks. Yeah, I got the two Frenchies. Come here, baby. Come here. There you go. Good girl. This is Lucy. She's smaller. She just turned 5 2 days ago, didn't you? Huh. You turned 5 2 days ago. So she's looking around. She actually was born and raised right on the beach. So, all right, there you go. Those are my two Frenchies. Now you've seen them. Fix my green screen and we'll get back to trading. I'm just having a good day. It's Friday. You know, what can I say? I'm having fun. Thanks. So anyway, these are consistently tradable signals that you see over and over again. And, you know, it increases your probability for success. It really does. Now, some of the disadvantages, really the biggest disadvantage is that there's a cost for the data. I was looking around, I found a free website, and then I realized it hadn't been updated for a couple of years. So, you know, most of the ones that are out there that do seasonal stuff for free don't last, unfortunately. So you do have to pay for the data. The two websites I like to use, I use two of them. There's MRCI and there's also Seasonalgo. So I'll go into both of those, and I have subscriptions and discounts for those as well. If you want to, the one I was mentioning first, MRCI.com, you can basically, there's a code that if you decide you want to get into it, when they see source, you would type in wealth and my name, and they'll give you a 10% discount. That 10% discount is only good on the yearly subscription. So it makes it $341 a year. On the other one, Seasonalgo, oops, it should be B. That one you have to message me or email me for a code. So you can always contact me through the support. And that is a 20% discount for the code there. And the 20% discount kind of goes block IP. No, it's yeah, the discount is support@wealthbuildershq.com. Okay. If you split it with a friend, I don't know. They might allow it. I have no idea. I think you can only log in one at a time. I don't know if you could, you might be able to get away with it. I have no idea. Don't subscribe if you don't need to use it. You know, that's the thing. It's extra money to pay that you're paying for something. So if you're not going to use it, then don't bother. But if you want to use it, if you find it's very useful for you, both the dogs went out in the sun. They're sunning themselves now. Anyway, then go ahead and get it. Yeah. So I'm going to go over here to MRCI and talk a little bit about how I can use this, because this really is useful to get that seasonal data for me, especially, like I said, when I'm planning out some seasonal trade ideas. And when we're looking at the wealth with either the wealth with spreads or the E-mini think tank, we do a lot of types of trades that are swing trades. So let me go ahead and open up real quick. Let's see. I think it was here. Yeah. 7-9 trade ideas. Yeah, it really comes down to probabilities and increasing the probabilities of success you might have. So if I look at some trade ideas, let's see, we had this one last week, or this past week, I should say. On one of the trade ideas we had was right here, ZWU21. It's a 4-hour chart. We were going to look at a short for wheat on the 4-hour chart. Now, I look at a zone, I look at the trends, and that definitely helps me, obviously. So if I go out to my charts right now, let me go out to wheat. I should have a chart available here. Let me close this one out. And let's see, what was that? Feeder cattle. Minimize that for now. Where's that wheat trade I was looking at? So many things I've opened up here. I was playing around with this earlier. Maybe I don't have it open anymore. Must have closed it out or did something different. That's okay. I'll just open up this one and we'll go for wheat, ZW, 09. There we are. So here's the wheat chart, and it's a 4-hour time frame that I was looking to trade here. There it is. And actually, there's the trade opportunity I was looking for. 650 and 6/8 and 654 even. So I was looking to short in this area. Prices came up there with my stop above, and then my targets where I identified based on Fibonacci extensions, which I took off. I don't have them on right now, but that's what I was looking for the trade opportunity. So you get target 1 and then target 2 down here towards that other demand zone down below. Or maybe that was I think it was a 3-to-1 reward to risk ratio. But here's the thing. It's a 4-hour chart. It is moving to the downside right now in trend. Is this a good opportunity? Well, looking at the chart itself, I'm on a 4-hour chart. I can go out to a daily, and I can see on the daily time frame, we are in a nice downtrend. So if we're in a nice downtrend, I should probably look for shorting opportunities, obviously, right? Trade with the trend when it does the little pullbacks. And I can also look at the weekly chart just to see, is this likely to continue to move to the downside? And looking to left, I don't see anywhere that this is going to bounce anytime soon. So to me, it looks like we should continue to move to the downside on price. That shouldn't be a problem either. Okay. So everything's pointing in that right direction. But if I really want to get an additional odds enhancement to make sure, or if I want to find trade ideas, I can use the seasonal charts. So I go over to MRCI, and I mentioned you got to sign up for this. If you do, you go to the MRCI Online. And right here, you see it says purchase subscriptions or a 14-day risk-free trial. They basically, if you cancel within the first 2 weeks, they give you your money back. They charge you first. It's not like what we do. Even in Think Tank, we do a 2-week free trial as well if you do quarterly, but we don't charge your card for the first 2 weeks. So if you decide you want to do that, no, seasonal charts. Yeah, they don't update it as much. That's the problem with that one. But anyway, right here, if you decide you want to subscribe to it, you go in and you click on MRCI Online Subscription, and you see right there $379. But when you go into the buy it now, if you were to check out, continue as a new person, like I said before, if you go down to where it says source right here, how'd you hear about us? You just say wealth, put in my name, and they'll go ahead and give you that 10% discount and make it $341. If they don't, let me know and I'll make sure to get taken care of. But here's the thing I'm going to use this for. If I go into my MRC Online tools, there's a section that shows me futures seasonal patterns. And there's a bunch of different securities listed. We can go soybeans, grains, meats, metals, fibers, on and on and on. So we are looking at grains. I'm interested in wheat, CBOT wheat, September. So I click on that chart. There's a pop-up that came up. That's a quick chart of it if you wanted to, but here's the actual chart. And what it's showing me is basically they took the full year for either 5 years, 15 years, or 30 years, and basically overlaid those charts and drew out the averages. So this is an average view of the average price of that contract over a calendar year for the last 30 years. And what I can do then is narrow it down into the time frame we are currently trading, which is July into September. And I can look to see, okay, so here we are, July 9th, right there. What normally happens in July over the last 30 years is that, well, we actually had a little bit of a rally. And then mid-July, almost late July, that's when prices started to drop. Well, that doesn't look so good for my swing trade anymore, does it? Because I'm looking to go short. Yes, I need a little rally to get to my supply, but not that much of a rally. Well, let's see, did things change? Because remember, this is going back 30 years. Everything is different from 30 years ago. So we look at 15 years and, oh, yeah, sure enough, it is a bit different, isn't it? Over the last 15 years, you can see we bottomed out there on the 7th, rallied up until the 12th, and then declined. We never made another high after the 12th, as you can see, for the life of the contract. Last 15 years, it's been pretty bearish. Last little spike in August and then died. How about the last 5 years? Has anything changed? The last 5 years, we didn't barely even get that last spike. As a matter of fact, over the last 5 years, the peak happens to be today. So we should be looking for shorting opportunities for sure. Seasonally, this should be diving. And over the last 5 years, if you shorted today, you made profits on average. It dropped all the way down to the first week, the end of the first week of September. That's the high probability that's likely to do, because that's what's done the last 5 years. Is it guaranteed to do it this year? Of course not. Okay. But the probability is higher that that is what it's likely to do. So one way I can use the seasonality of the markets is to verify what I've already decided I might want to do in a trade and get a kind of an odds enhancement or more confidence in the position itself. So that's what I did here. I looked and I found that, yeah, I'm looking for a short. And sure enough, the trend is normally to the downside this time of year. I'm on the right side. Another way of looking at this, though, is to use it to find trade opportunities. If we go to another security, let's say we want to trade the equity markets, and I go to the indices, and let's say we want to look at the Russell. So I go to the Russell September, close pop-up. We can simply look to see what normally happens this time of year in the Russell. And I can shrink this down, changing that. July, August, September. Again, we can go to today's date, 9th of July. And normally what is happening with the Russell, you can see the first part of July is usually pretty flat. But July 9th onward is somewhat bullish, isn't it? Till the end of July, and then it takes another breather. And we can compare how it's changed over the last 30 years. Let's see, we got last 30 years, it was pretty flat. I mean, again, rising just barely. It's not the best time to buy, is it? Or we can look at the last 15 years or the last 5 years. Last 5 years, obviously, is going to be the most impactful. Sorry, that was 18, not 30 years. Over the last 5 years, July 9th, wasn't a bad time to buy, was it? Because historically, over the last 5 years, from July 9th until July 26th, we've had a rally in the Russell 2000. What I really wouldn't want to look for is where there's a really big rally or a really big drop that's been consistent over time. We don't have that here. So I can look for another index. We can take a look at the S&P. And on the S&P, again, I'm just go to where we are now. Don't worry about the past. And in July, we can see this has been pretty bullish, but nothing dramatic. I want to see a really big move up or down. I'm just not getting that yet. So we try another one. The problem with doing this is you're spending a lot of time trying to find something that may or may not be there, which is a big move in the markets, right? So there's going to be an easier way to do this, and I'll show you. But I'm just giving you an idea of what you can do with the seasonality, because again, if you get a consistent signal, for instance, right here, June 27th to July 20th. So basically for the month of July, really the end of June, beginning of July, for 3 weeks, this should be a pretty good rally going on. It has been consistent for the last 25 years. Even the last 5 years in red still went up pretty significantly during that period of time. So if we take a look at the Nasdaq, if we knew this going into June, we're still in the middle of it, so we still might have opportunity, but we should be more bullish biased until July 23rd to 25th. So we go out to our chart and we look at the Nasdaq. I think I already have that open up here. I do. There we are. And on the Nasdaq, as I mentioned, it was right around what, June 27th or so. And by the way, it's not always going to be exact. Okay. Just because it's around that time doesn't mean it's going to be exactly that time. You can see that we've got 24th. No, 27th was the weekend, so it'd be the 28th you could have gotten in. Okay. The yearly criteria are a little different on some. That's just what they did. I don't know why. However, you can see right here, this would have been your entry on the 28th on the open. If you're playing just the seasonal spread or seasonal move, you would have been buying there. And how's it working out? That's pretty good, isn't it? That's a buy at what price? About $350. So it's up about 1,300 points already at $20 a point. That would have been good to know. Crypto doesn't have enough history to do seasonality yet. That's the problem. Remember, we're looking at long time frames. The only one is Bitcoin that would really have any kind of history. And even then, it hasn't been consistent. So the part of the reason why these are very consistent is because you got the big institutional participation, and cryptos don't really have that yet. So we can always even look back And I probably shouldn't do it on this contract. I can just do the continuous. Let's do that. Oh no, this is continuous. I forgot I changed it. So we go back on the continuous contract to last year, and same thing. If you were to have looked at this right around mid-June, right here, June 27th is what I was looking for. And we didn't have that. That was the weekend. So you would have gotten in on the 29th right here. Oops, wrong button. So here's the 29th. Oh, I didn't take. There. And right there, if we had gotten in on the 29th, remember, we're supposed to carry this till about July 23rd or so. See how this worked out. 23rd, it's right there. So even if you held it the full time, you had a rally from about 97.59 to 10,500. So that wasn't bad, right? I had a nice good rally. It was even higher at one point, obviously. You may want to take some profits as it made those highs and failed. But even if you held on the date seasonally, that was a win. And that win would have been, let's do it this way, about 15 grand, almost $16,000. Not bad for a seasonal play. And all we really had to do was just find an area that seasonally has a strong move. And you can do this on pretty much any security. But you can see the seasonal move on this is pretty consistent over the last 30 years. That's a key thing. There's another one towards the end of the contract right there in September 9th through the end of the contract, usually a pretty bullish move. Now, you don't want to hold the contract into expiration. So instead, let's go to the December contract and see if we can take advantage of that there. So we go into the contract. We bring this down to the end of the contract right around September, right here. There it is. Okay, bring it over a little more. Actually, let me shrink this down a little bit. There we go. It doesn't look quite as bullish, but this is what I was just looking at on the other page over the last, was it 30 years? Or is it less? 25 years. Over the last 25 years, September 10th through the 20th, that 10-day period has been pretty bullish. The last 15 years has been even better. Last 5, not as good, but still bullish. That means there's a high probability if you buy on September 10th for the Nasdaq and hold it to the 20th, you're likely to make some money. It's not a guarantee, but let's take a look. Let's test the theory, right? Because we got the charts here, might as well. Oops. Yeah, come on. Delete. It's excellent info for a trader. Yeah, absolutely. So if we go right here, September 10th, there it is. Well, it didn't work too well. You can't blindly just buy and sell. You got to use your zones, look for demand and supply zones. But if we know right around the 7th through the 20th, you're usually going to look for a rally. Actually, this one definitely disappointed. Last year did not work whatsoever, as you can see right there. So that may not be so good. Remember, we saw in the 5-year wasn't as good, right? So we want to find one that all 3 of these are excellent. There's another way to do that. Okay. So another way to do this is let the experts find it for you. And, that's kind of what I do in the Wealth with Spreads program, which I'll talk a little bit about in a little while, but also in the E-mini think tank, I find a lot of opportunities for traders by just scanning on my own and finding some of these things. What effect did COVID have? You're talking about on the Nasdaq? Well, that was the crash we had early in the year until March. Right there. That was the COVID effect right there initially. Then we rallied up out of that. So yeah, I forget what the percentage drop was. It was pretty good. I think it was that. I don't know. I'd have to look exactly what it was. Anyway, what I was going to say is that if you go into a different section of MRCI, instead of trying to scan for yourself, right here, I'm not going to give you the current ones because that is their site, but I can go to the previous ones and let's see, we'll just do May. If I go into May, first of all, what they give you is a trade outlook. These people have been following these markets for dozens of years. And what they do is they put out a little snippet about what they're expecting during that time of year. You can see what they're talking about with currencies, what's going on with the Australian fiscal year and the Mexican, Canadian. Actually, this is the August trade outlook already. It's weird. I went to that one, even though I clicked the old one. But stocks and bonds, what to expect. Energy is what to expect. So they give you a quick little write-up about what to expect in the markets coming up seasonally. Then what they do is, and I'll show you the May seasonal trades, they select 15 high probability opportunities. Remember how I was just going through those charts and looking for big rallies or big drops? Rather than having to do that myself and write down the numbers and hopefully remember them, I can simply look to see what trades do they recommend. Now, they're not perfect. I mean, they're recommending spread trades, or sorry, not spread. They're recommending seasonal trades based on what has happened in the past. No guarantee it'll happen again. And here's the other thing. Do not blindly take these trades just because it tells you to buy or sell on that date. Use your knowledge of the markets. And if you don't have it, I'll help you. We've got plenty of information here at Wealth Builders HQ on how to trade the futures markets. I did a futures boot camp a while back. We also have the E-mini think tank, which will help you with getting more knowledge of this. But by using the tools we have, let's say you're looking at, what do we have here? We got 93% on November natural gas. Okay, so let me click on that as a trade opportunity. And what they're suggesting here is selling short on the 16th of May, getting out on July 17th. That trade's already finished. We can see what happened this year. But over the past few years, it shows you the entry date and price, exit date and price. It says approximately. Doesn't mean you have to immediately on the 16th, I got to go buy or got to go sell in this case. No, you got to make sure you're selling at a good level. Okay. There are people that just blindly do it. It's not smart though. And here's why. On the 16th at 12:01 a.m., right? Now, what happens is take a look at this one gain. This was a gain they had of $1,000. They made $1,000 profit. The problem was at one point they had a drawdown of $1,620. Or how about this? $5,700 drawdown to make $3,800, or $22,000 drawdown to eventually walk away as a winner of $6,800. No, I don't think so. I don't like that. And I don't think you do either. We don't need to suffer the drawdowns. Okay. So what we should do is that we should be focusing on, this is when we should trade it, but we should look for the zones to make sure we enter and exit the right prices and the right times. So again, this was May 16th on Nat Gas November contract. So we're looking at the X contract, and let's go ahead and bring it up. So we'll bring up the symbol here, and we're using NG 2021-11. Oh, sorry, it's NG3 that I need. There we go. It's the electronic contract. Okay. A bucket shop? Yeah, they are illegal, I think. A drawdown is a losing trade that you didn't close out. Your equity is drawn down that much, even though you haven't closed the position, so you don't call it a loss yet. The equity amount is drawn down. It's basically a loss, because we're doing mark-to-market accounting when it comes to futures. So really the loss happens even though you don't close your position, right? So let's see, I'm still in the previous year. This was, again, I forgot what date it was. The 16th of May to the 17th of July, they're looking for a short year. And this is the wrong contract for last year. So let's go to this year. There we go. And I don't know if this one worked this year either. May 17th. Is that it? '16th. Sorry, my bad. 16th. One day off right there. May, well, 16th was a weekend, so 17th anyway. So there we are on May 17th. Okay. This, at that point, that's a security that just broke to a new high and in a strong uptrend. Should we sell that right now? Should we be shorting that? Probably not. You take a look to see, is there any overhead supply here? Doesn't look like it. So not necessarily a good idea to short that, right? Stock Trader's Almanac might work similar to that, but it's not going to be as in-depth as what you see here, because you're going to get more updated information when it's dynamic rather than static. So right here, we just broke up the new highs. There's no way you want to be selling that. Even though we're very overbought, it could become more overbought. We call that a trend. So I just probably would not have taken that. The other thing I would look at is on the trade itself. If you scroll down a little bit here, you can see it brings up the current price in a bar chart format versus the last 15 or whatever time frame you want, 5 years, 15 years, or 30 years. And if they're not doing the same thing, notice the pattern was not quite the same. We were already dropping down here before this. I'm sorry, that was saying you're supposed to be dropping down, showing weakness before the entry. And this just kept going sideways and up. So if your current market is not following the pattern of the historical market, it's probably not going to keep working. So that's a clue for me that if I look at a seasonal trade and it's not following exactly what I expected to do, what it's supposed to be doing, then no, I'm not going to bother with it. Or if it's obviously in a strong trend opposite of what I'm looking for, I'm not going to trade it. So I'm sorry, I want to do this, go back. And we can look at other trades that were there. We had the Euro Forex. This was a buy the Euro on the 26th of May and get out July 1st. And you can see the same thing. When we look at the patterns here, that was the pattern that we were in the bar charts. The blue is the historical pattern. Well, historically, it was supposed to drop so you could buy, and it did not. So when you get to the first part of that yellow, that would have told you, no, probably not going to work because it's not following the seasonal pattern. And seasonal patterns do get broken for many different reasons. Things like the government intervenes, right? Or there's a drought or hurricanes or floods or whatever it may be, but they do get interrupted. COVID, yeah, that's another big one, right? That interrupts things. So another one, silver, 80%. Some of these are pretty high. Let me go to a different month here. If you go to June, and let's see, we've got the highest percentage is 100%. So we had 200%ers. We had live cattle that was being told to buy on June 18th. And it worked a little bit. Actually, was that? That's the pop-up. Let's go to the actual trade. There it is. Here's the actual trade. Just because it worked 100% of the time over the last 15 years doesn't mean it's going to work this year, number one. And number two, again, you got to worry about the drawdowns. You know, it might make money, but if you have to go through a horrendous loss before it makes money, it's not really worth it. You know, $360 profit after it was down 1,020. That's not fun. So you got to find out what the average win is going to be, which is right here. See, the average win is a little under $900. And I would probably set up a stop at 1/3 of the potential gain. If the potential gain is $900. Don't risk more than $300. It's just common sense. Plus, we can time our entry rather than just blindly jumping in because the market tells us to. This was live cattle December contract on June 16th. Okay, so we go out to live cattle here. I'll bring in the symbol. It's LE 2021-12. There it is, live cattle. And let me pull this back to the June. Sorry, it was how many days? A couple of weeks. So probably could have done an intraday chart, but it's a buy on the 18th. Let's see, where's June 18th? May, June, there we go. '16th, 17th, 18th. Now remember, it's approximately the 18th. And one of the nice things was it looks like we had, I don't know if that would have worked or not, but it looked as though we had some sort of a zone here. Whoa, somebody had keyboard locked. Paul? That's okay, no problem. Anyway, so right here, you can see that we were waiting for this to come back and look to buy. It didn't quite hit the demand zone there on the daily chart. We have, I guess, kind of rally base. Actually, maybe it did if you use the whole thing. Rally, base, 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 that's 6, and then the rally up. So there's your entry point right there. That's a possibility. Now, usually what I do, just to give you a heads up, going back here, notice it says average profit per day, number of days. What happens is if it's less than 21, or sorry, if it's 21 or less days, I usually use an intraday chart. So I might use an 8-hour or 4-hour or 60-minute chart. So if it's 21 days or less, I use an intraday chart. If it's more than 21 days, I typically use a daily chart. That's the difference between the two that I do. Okay. So we look at, I'm sorry, it was, which one we're looking at here? Totally blanked out. It's the 100%er there, the live cattle. That's a 19-dayer. Okay, so we could do an intraday chart on that if we want to. So instead of this daily chart, if it's 21 days or less, I either use I use an intraday chart basically. So if the duration of the trade that's just my rule. You can change it too. So basically intraday chart, I'd use a 480 minute, 240 minute, or 60 minute. I usually don't use less than that. Now, if it's 22 or more days, use a daily chart. There you go. No, I don't know about that, Pat. I've just got more experience. I wouldn't say I'm smarter. I've just been doing it. So anyway, that's it. So we can use the intraday chart instead of daily. If we did do the daily, again, the entry was on the 18th. The exit is supposed to be at or about. Again, they use approximates here. They don't say exact, but the approximate exit for that live cattle is July 6th. And if we go forward here, July 6th, there it is. 6 is this day right there. So there's the exit. That was a winner this year. Right there. Depends on where you got out, obviously. You could have gotten out at a better price or gotten in at a better price. I was saying, if we go to a 240-minute chart, here we go, 4-hour chart going back in time. What happened? Oh, I need more data. Yeah, it is recorded. Let's see. It'll be up on YouTube. You'll be able to rewatch this. 180. Oh, yeah, kicked off there. Yeah, 180. There we go. I'm running two programs at the same time. That's why. Did I type 12? Yeah, I'm at 21. Sorry, I might have mistyped that. So basically, yeah, what we could have done here is on the 4-hour chart is reduce the amount of risk. Look at that. We have drop, base, 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 rally. So there's your entry on the 21st. Again, it's approximately the 18th. Doesn't have to be exact. And you can get out when you hit supply. Well, our first supply zone was right there. We could have exited there. Rally-based drop, right? So in essence, we could have made this a really quick trade if we wanted to, where you got in on the about 1:30 on the 21st and exited when it hit supply at, wait a minute. Yep. 1:30 the next day, 24 hours, you made your target right there if you wanted to. Now, if you held on and until the 6th, you pretty much got out at the same time or same price, maybe a little less. But that would have been a nice trade. We went from 129.40 excuse me, to 132. So what is that? 3 points? That's $1,200. No. Yeah, $1,200. Sorry, $400 a point, I think. Yeah, $1,200. It's a pretty good opportunity. And again, it just comes down to knowing the right seasonality. That's just one contract, right? Now, here's the thing that we can also do. If you want to reduce your risk, okay, let's see. If you're between entry and stop with some loss, would I've identified the exit, the date? That's the end. I'm not sure what you mean by that, Bill. I mean, if I was looking at this initially at the time I was entering, there's the entry with the demand zone, drop, base, 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 rally, and we're right around the date we're supposed to enter. Looking left and up, there's drop base, rally base drop for supply zone. I would look back to see if there's anything else. Okay, I get it. If this had gone, it had not hit supply yet, and it was still moving up, but the expiration date came up for the seasonal exit, but if I hadn't hit the target, would I exit? Yes, I probably would. Well, actually, no, I take that back. I trust the charts. Remember, it's approximately that day. So if it takes a little longer to get there, it's not necessarily a good thing. Your trend is weak, but it doesn't mean you have to exit just because time's up, I got to go. You could, but if you're not quite at your targets, you could wait a little bit longer. So yes, I got it now. Yeah, let's say this was supposed to be exiting on the 20th, and here we are on the 20th. We haven't gotten into our target yet. We're still moving up. You don't just necessarily have to exit, but you just have to have a plan. Exactly. Stick to your rules. So you can see this can work. But here's the other neat thing we can do. If we wanted to reduce risk, we can do what are called spread trades. And this is part of that program I was talking about called Wealth with Spreads. Excuse me. I'm having problems with allergies today. So with spread trades, we can reduce our risk and still do directional trading. So what we could have done here with the live cattle, instead of just buying and selling live cattle, which by the way, if we did that, let me show you what it would cost. You can go here and margin calculator, clear out these old ones. And let's see, we'll add in LE, I forget which contract we were doing. Was it live cattle? Oh, it was December. Okay. So LEZ 21. This is not going to be too bad, but if we had one contract held overnight, it was $1,760 to make that $1,200. Now, another way of trading is called a spread trade. And what we can do with a spread trade is you basically trade two contracts against each other. And the reason why you do this is because you profit not from the price itself moving up or down, but because the relationship between the two securities changes. Excuse me. So let me just bring up LEZ 2021, same contract. Nope, it didn't take. What happened here? LEZ 2021. There it is. And we'll bring this to a daily chart. And what I can also do is compare it. And let me compare this to, I don't know why it's delayed. I got to fix that. But let me compare it to LE, let's see, G 2022. This is the February of 2022 contract now. And let me change the first one to a line chart. Okay. So what is now happening is that if you notice, the two contracts aren't moving together. One's moving faster than the other. They're not moving at the exact same pace. You know, if we move to the upside, for instance, let me see if I can get this bigger. And what were we, June 18th, something like that? I mean, I show me as well back here, but you can see right there on the rally, June 18th, it did rally up, but the contracts did not move at the same pace. They're similar, yeah, but they're not the exact same. You see one move faster than the other. So a spread is simply the price difference between the two contracts. As an example, let me just, okay, zoom in more. Yes, I can, good. Do this. There it is. So when we look at these securities, for instance, right here, the two are touching. Can't even tell they're two different securities. They're touching right there. But then what happens? The price difference between the two separates right here. And what that means is the contract in yellow went up faster than the one in blue. Well, because they're both the same underlying security, they're both cattle. Okay, the blue happens to be December cattle, while the yellow or orange, whatever you want to call it, is February cattle. And what's happened here at this point, the February cattle is more expensive than the December cattle. But they're both cattle, so they should be about the same. They shouldn't spread out like that. The spread is the price difference between those two. What we can do as traders is trade the spread. And the reason why you do this is it reduces your margins and reduces your risk compared to directional trading. Here's why. First of all, what we would do is we would sell the orange. At the same time, you would buy the blue. And we're doing that right here. And what happened? They came together right here. That would have been a winning trade. Why? Because when you sold the orange, obviously it went up. Orange loses. But at the same time, blue wins, right? Because we bought there. And it wins more than what we lost in the orange. As you can see, the price movement for the blue was greater to the upside than the loss was for the orange. That didn't go up as much. That's all a spread is. Okay. So a spread is simply looking at the price difference between those two securities. And there's two ways of trading this. One, if you think they're going to move, but they're going to move at separate paces, you can trade for the spread to widen, or you can trade for the spread to narrow. Okay. Now I'm oversimplifying this. There's a lot more to learn about this. And like I said, if you're interested in learning about this type of trading, you can learn it by going into and joining on that link for the Wealth with Spreads section. So if I go to Wealth with Spreads, let me just show you here real quick. Wealth with Spreads is designed to be more self-paced with the education. You go to educational videos, you have all these videos to watch on how to do spread trading. And then what happens is every week I put out a video. Right here is the video from last week, and the video itself, as well as a PDF for the spread ideas that I put out. And what happens with this is kind of neat. I'm really just hand feeding you the trade ideas, because I put out the video usually Saturday morning, Saturday afternoon, the video is ready, and you can watch it and set up your ideas if you want. And then what happens is you sign up for SMS alerts. And actually I can look at the last 20 messages right here. So right there, we had GE, which is $0 versus the treasuries. And the short that we had on that from May 30th is halfway to target number one. We had to move our stop down to protect our profit. Silver versus gold, we got stopped out for a short, for a loss, unfortunately. So what happens is these are SMSs that get sent to you real time to let you know when it's time to trigger entries, trigger exits, and manage trades to adjust the stops as well. So it's kind of nice. I kind of give you the information on how to do the trades and then show you the trades as they're happening as well by the SMS. And the video, as I mentioned, if you go into these videos, I don't want to watch the video, sorry, but I can go to the PDF for the video, and you can see it shows all the trades for the week. And then individually, I go into the trades and show you, this was one of those MRCI trades, silver and gold, seasonally. They were right 87% of the time. This month, it wasn't right. This one lost. But what we were looking for was that kind of a move. And then here's what I can do. You were asking earlier about how do you figure out supply and, I'm sorry, how do you figure out risk and reward and where to place your stops? We still use charts on these. What you can do with a spread is you can chart spreads. So for instance, we were just looking at the cattle. I was just kind of off the cuff to creating the cattle spread. We can create a chart right here. And I'll do this. We'll put it as LE 2021. Was it 11? That was November. Or wasn't that? No. I think I already have one here, don't I? No, that's November. Yeah, that's December. Sorry. We'll do December. Live cattle. There we go. And what I can do then is create a spread chart where it's going to take one security minus the other. And that actually already picked February, so I'm going to just use that one. And this is going to show a line. And this line represents the price difference between those two securities. Lucy, what are you crying about? Come on, stop it. What she's crying about. Anyway, bear with me for a minute. Where's my other dog? Oh, there we are. Okay, they're fine. Just making sure. Usually they're right next to each other. All right, so what happens here, this is showing me the physical difference between those two contracts. So again, if I go back to my chart, oops, where I have it right here. And let me close that out. Back here. And remember, right here, I was looking at the December contract versus February contract. If we go to the hard right edge, you can see that price is the difference. I'm sorry, the spread is the difference between these two contracts. Notice this December contract is below the value of the February contract. So if you subtract the December, I'm sorry, Yeah, just subtract the February from the December. That's what you get right there. That's the price difference between the two. Remember, the December is lower. Yeah, it'll be on the Wealth Builders HQ YouTube channel. That's where this will be. So the spread that I'm looking at right now, this line, that number, negative 4.3, is nothing more than the price of this contract subtracting that from that. The two prices subtracted. So that's the physical difference between the two. That's what we can do for a spread trade. We can look at this, and then I can even do a few more things here. So let's go ahead and edit spreads. Again, this is just an overview of what can happen with spread trades, and I'm going to take it back to the seasonality in a minute. So let's do 180 days there, and let me get some more space on the right-hand side. There we go. Yeah, perfect. And the reason why I did all that is now, if I want to see what or how to trade this, I can chart it. I can look for, and there's certain tools that you use to figure out when it's time to trade in one direction or the other. So let's go to a daily chart here. And again, bring it back to the candlesticks. I have to change that again. And it looks a little wicky. It's probably better to go with the, oh, it was 180. Do 360. You know, and keep it on a line chart rather than the other. So it looks as though we've got a low that we have not seen in a while. But what I can do is I can try to figure out when this is overdone, meaning it's too far to the downside and it's likely to rally back up. And there are several different techniques to do this. One in particular that I could use is a Bollinger Band. But this is how I find trade opportunities and put them out for the spreads. And I'll show you in a moment why we want to do these spreads. So here's Bollinger Bands. There it is. So for instance, if we go back just a little bit in time here, let me just bring in another indicator in a moment too, or for a moment. It's warm here today. There we go, RSI. See, sometimes I have to do a second time for it to go in. I don't know why. Yep. There it is. So what I was looking for here is the fact that this is, let's see, there it is. Outside the band, inside the band. So what is happening is that we became very oversold. Now, normally, really what I should look for is the trend as well. And we're really in a downtrend here. So the best way to trade this is on the short side, not the long side. But if I want to do a counter trend trade, this is setting up for a small opportunity. And the reason why is prices were making fresh lows while the indicator was not. And we call that a positive divergence. So with a positive divergence, and we were closing outside the band oversold, became less oversold because we closed inside. If I go long in the next contract, we have a high probability of at least getting back up to the midpoint, if not to the upper band. And that's what I can trade for. So if I know, first of all, before I go any further there, if I know I'm going to get in on the open, let's do that. We'll go to the next candle. So if I know my open right here is my entry price, my target first is going to be the midpoint, which is obviously adjusting. And that shows me a potential gain of, let's see if I can find that. I'm gonna have to go one more. Showing like over $2,000, I believe. Let me just see. What's that? Oh, sorry, $270. Small transaction or small gain. So if I'm making $270 there, I can put my stop at 1/3 of the potential risk, right? Well, that'd be right back here, $90. $90, there it is. So I place my stop there. And obviously the target's the midpoint. And what happened? Right there, it went. So we could have gone long at the beginning of this green candle because we had the close outside, close back inside, positive divergence, long opportunity, target hit right there. on the next candle. So that was a 24-hour trade, made a quick $270. Now, here's the neat thing about this, and the reason why I love spreads. If we had done just one contract, just buying LEZ, which is the December contract, your margin is $1,760. However, if we do this as a spread, now we add in a second contract. Oops, let's do it this way. We were doing the February, LEG 22. There we go. We were shorting one and buying the other. My margin dropped from $1,300 down to $578. So even though I didn't make as much money, I made $270, right? There we go. Made $270. I did it only using $538, and I made a rate of return of 50%. Yeah, $578 for each. No, not each contract. It's two contracts for $578 total. Yeah, you get both of those. It's a spread trade. That's why the margins are so much lower. Remember, how can I make money on the spread? 3 ways. Think of it. If I go back here, the way these two contracts came together, that's the only thing I needed to happen, right? So remember, we did, hang on. We did sell orange and buy blue. So how could those 3 contracts come together? One, which is what it did, was they both moved up. But blue moved up further and faster than orange did. So that's how I made money. What if they both went sideways? It doesn't matter, because if they come together, I still make money as long as orange goes down and blue goes up. If they both just go sideways, I don't make or lose. And here's the other cool thing. What if they both went down? Well, as long as the orange went down faster than the blue, I still make money, which means I have 3 different directions I can make money, up, down, or sideways. I don't care which direction it goes. I am neutral on direction when I do a spread. So that means I have a higher probability of making money, lower probability of losing money. That's why they drop the margin so much. And it can drop dramatically. Let me show you this one. If you do spreads on equity markets, it's amazing. So let's do this. Well, I'll change this to NQU21 Nasdaq, and the overnight margin on the Nasdaq, $17,600. If you go to NQH21 or 22, sorry, overnight margin went from $17,600 to $1,980. So it dropped more than 50%. Now, this was huge. That's 1/10 the margin. Isn't that amazing? It actually used to be $55, but now we got more volatility. The reason why, these are much safer trades. There's a lower probability of losing money. Yeah, it used to be $55 until about 3 years ago, and then it became much higher, $1,980 though. But it's very difficult to lose money if you know how to do these properly. It's possible. The way you would lose money is if the spread widens rather than narrows. And yes, by the way, this is being recorded. It'll be available on our YouTube channel. So you'll be able to rewatch this again on the YouTube. Okay. For Wealth Builders HQ, look for it there. So anyway, getting back to this, if you're interested in joining, basically what happens with the spread, losing all in one trade, I don't know how that'd be possible. They really have to screw up. Because remember, what happens with this is we're trading for the reversion to the mean. When it comes to these trades, we're really trading for the average, the reversion to the average. And especially when you combine it with the spread knowledge. Oops, I was on the right page there. Let me just show you real quick here. If I go to MRCI, remember on the June trades, we have 87% right, 87, 93, 100, 80, 100. So there's a lot of very successful trades here. When you go to seasonal spreads, we had a bunch of 80s on the directional. There are no 80 percenters here. They're all higher, 83, 93, 87, 93, 93, 100, 87, 93. Usually these are higher probability trade opportunities. And when you look at the drawdowns, for instance, hogs, it's 100% winners for the last 15 years. Even the drawdowns are relatively small. That one's a little big, $900, but they made $1,800 eventually. That one wasn't so good, 604, made 448. But for the most part, a lot of these drawdowns would be very, very small because the movement, remember, you are losing directional risk. You don't have any directional risk. So when you combine seasonality of, hey, this pattern happens almost every single year for so many years, And yeah, the drawdowns weren't as big in comparison to what we saw on the other securities. So you can do that there. The other source that I have is called Seasonality. And with Seasonality, I can actually build my own as well. But they also, if I go into portfolio, I think it is, no, strategies. They have some spreads that they recommend that I can look into. Once again, I don't blindly take the spread trade, but I actually use it for an idea. And then I go in and I look at the charts. So for instance, here's a corn spread. Okay, they were getting in on July 13th and now August 28th. It's coming up. It hasn't happened yet. Last 15 years, I'll zoom in. The last 15 years, they've been right 100% of the time, 15 out of 15. So they're going to play the sell September corn and buy May corn of next year. They usually get in again, July 13th, out on August 28th. They're in the trade for 47 days. The best win was 485. The worst loss was negative 270. It's not too bad. These don't have huge drawdowns typically, unless you have large wins, and you can control your risk much better. So if we go out and take a look at the chart, now I can see if this is something I might want to trade. First of all, I look to see, is this following the pattern? And it's a little bit soon. The drop, you notice this move right here is happening early. But it does look like it's somewhat bearish, so there might be the opportunity for it to drop. So I can build an interactive chart right now and see. And by the way, looking at the seasonal move, look what happens. Last 5 years, boom, it just collapses. Last 15 years, still pretty good drop right there. So if I go into the interactive chart, I can get a little more detail here and change things around. I didn't want to cut that out. There we go. So there's the entry date, July 13th. Usually you start to see prices decline then. And there's the exit, August 28th. And I could put in other tools such as my RSI that I like to use. And I could change the parameters as I normally do. Why was it more bullish this year? There could have been things like COVID. It could have been any number of things. You know, we'd have to do a little more digging into it. But overall, if it looks like it's going to drop, what I can now do is take this spread chart as well. So ZCU, ZCK. By the way, to hold that, it just tell you how much it would be. You can look at the margins here as well. Corn. ZCK 22. Overnight margin is only $990 for this pair. Now remember, the average win was, I think, 485 was the biggest win. I don't know what the average was. I'd have to look at that. But that's not bad. It's a 50% rate of return if it happens. So we can go out to our charts and chart that out. Rally prior to the drop, alter your decision to profit earlier. Maybe. Again, I look at the charts. Oops, cancel. I want to do, let's see, charting. New chart. So it's all depending on the chart. And it's ZC 2021 12. That's the first part. And then I go in and I create a spread chart on this program. I'm going to do ZC 2022 05, which is the May contract that I was asking for. Hit OK. And it should bring up that chart. Don't try to be smarter than the odds. Yeah. So there's my spread chart right there. And let me just widen this out a little bit. I need to get some more data. There it is. There's a duck fight going on in the river right next to my house in the backyard, and my dogs are looking at them fighting. It's kind of funny. Anyway, let's see. I don't want to do it that way. I can do it with this, but yeah, I can look to see when is the best time to take this trade. They are looking at a sell order here on the corn. So looking for a short opportunity. If I go out to a weekly chart, I can look to see what the trend is. The trend is very bearish right now. I can look at the daily chart as well and look and see when it's time to enter. One of the best times to enter for a bearish opportunity would be when we rally up to areas of supply. We may have already missed one. And I say that because right here you had kind of a drop-based drop. And maybe we have this rally-based drop. We'll have to wait and see. With the candlesticks, obviously, it's a little bit easier to do zones, but I can still do them here on the line charts. And I can wait for a move back up, or I can also add in other indicators to give me probabilities. One of the things I would love to do, especially when it's intra-market spreads like this, is use a Bollinger Band and sell when we become overbought in a downtrend. Well, overbought in a downtrend is one of two things. It's either going to be piercing the upper band, or more likely it's when you're crossing below the midpoint. So kind of like what we've seen already. Let's see, there we go. If you go back in time a little bit, pull this back to here, for instance, we can see it's getting ready to cross through that midpoint. So there's a short opportunity. If I know that's my short opportunity, oops, hang on, what happened there? Trying to get rid of that. There it is. That's going to be my selling opportunity. As it's crossing below, I can see what my potential gain is going to be, which is the bottom of the band. Take that 87.50 divided by 3 and place my stop accordingly above. Now, this wasn't a huge move. Ended up coming back up again. So once again, if it starts to go back down, I can go ahead and sell. Oops. And by the way, I might have exited this already because it came close to the band, even though it didn't break it. I might have been able to get out for a win at one of these points. So second time is a charm right there. We can go ahead and sell when it crosses below, once again, targeting the bottom band, or if it keeps going below the bottom band, you wait for it to come back in. There's a lot of things you could do with this to find opportunities. And in this case, if we had sold right here as it was breaking the band, we would have bought to cover either as it broke the bottom band or if it came back inside the band. They're pretty much the same area. It would have been a gain of about $112, but we've only been using $900. I think it was $980, $990, yeah, $990 for a $100 gain. So what is that, about 15% rate of return? Not bad. So that's a little bit about the seasonality and spread trading. Like I said, if you want to learn more, one of the best things to do is join me in the Wealth with Spreads or the E-mini Think Tank program. The E-mini Think Tank program is just directional trading where I do apply the seasonality when it comes to the larger time frames for some of our swing trades. But if you're interested in the spread trading where we actually reduce risk and find better opportunities, those are swing trades. They're not day trades for the Wealth with Spreads. And what we're looking at there is holding on longer periods of time on those spreads, reducing the margin costs. Some of the trades are under $500 for the margin. It's really, really inexpensive. I'm trying to see if I have it available right now. Let's see, EXCEL. If I go to the June, not all the trades have been finished yet, but I can show you kind of what we look at. And like I said, you get alerts as the trades are happening. So it's not just here's all the trade information, good luck. It's here's the trade information. Then you get messages when they're hitting their targets or entries, so you know when it's time to get in. So you can click on the links to see which program, depending on which program you'd like to join. Let's see, that is, trying to bring this over. Here we go. You know, I'm honest with everything. I show you the wins and the losses. And what happened was, this is June, so last month with the Wealth with Spreads, not all the trades are finished yet. You can see a couple of these are still open. They're in the trays right now, and we've got some wins going on that we are moving our stops with. So we've got wins and losses averaging. This was only 4 in that week. Then there was another 5 that week, 6. So I averaged about 5 to 6 trades a week. Out of the trades, we had 7 winners for the month of June, 6 losers, 5 no entries, and a few still open. Quite a few still open, actually. And we did well. Our win percentage was 53.85%, but because you see the wins are larger than the losses, we're profitable for the month, and our rate of return, depending on the size of your account, 10% rate of return in 1 month with very low, limited risk, which is a nice thing. Let's see, do I have the other one here? July is just getting started, so I don't really have a lot there. Just trying to see if I open up May. Show you that one actually only has 1 trade still open, but is a big winner right now. So let's see, there it is. May was a big month. You can see right there, we actually had a lot more winners 20 winners. So hoping we get a repeat of that. It was right 80% of the time. You can see the win was $763. The average loss is $280. So it did pretty well on the wealth with spreads. Okay. One trade open today on the HE. Yeah, there were some. The margins are not built. It's not built for large accounts. Yeah, the margin requirements are low. So, I mean, you could do max number of contracts, but it's also good if you just do one contract. Spreads ideally are good for retirement accounts because you are reducing the amount of risk you have per contract. So for retirement accounts, it's actually a really good opportunity, which could be your large account, obviously, right? So it just depends. If you have a self-directed IRA, you can do these. Yeah. Anyway, I'm going to get going. I kind of went overtime here, but I wanted to share that information with you about using these seasonal information on these charts to get better opportunities when it comes to the markets. And you can do that, again, by using some of these resources. And one of the resources that I have for you as well as myself, teaching that in both the Wealth with Spreads program and the E-mini Think Tank program. So I'd love to have you guys out there. How would you balance out trades like this if you also want to do E-mini trades? You just have to just kind of select to see how much money you want to allocate towards each. They have different goals. The E-mini Think Tank is more shorter term for income, money that you're going to be using now to, pay bills or do life things. Meanwhile, the Wealth with Spreads is money that you're not going to touch right away. That's for building your long-term wealth. That's where the kind of the focus is. So you got to decide kind of what you can afford to put into which account and how much risk you're willing to take. The Wealth with Spreads definitely has lower risk overall because you are taking spread trades, which naturally have the lower risk as well. So again, we can always talk more about it if you have individual questions. You can send a message to support. I'll give you the email address. It's just support@wealthbuildershq.com. There you go. Could you trade options on spreads? No, not really. You'd have to trade options on the seasonal trades because you can only trade options on the individual securities. But again, in the E-mini Think Tank, I actually did a module on options on futures. So if you go there, then you can learn more about that. But you can't really do options on the spreads because they're not an individual security themselves. You can only do an options on an actual security, not an option on the spread. It's kind of weird that way. Okay, great. If there's any other questions, let me know. If not, I will see you next time, hopefully in one of my programs, the E-mini Think Tank or the Wealth with Spreads program. I'm actually going to start working on those after I take a little break today and have some lunch and relax and enjoy the sun. So thank you for being here, everyone. I appreciate it. And take care and trade well. Trade safe and trade well, everyone. Oh, thank you. Yeah, I'll get on the Harley, enjoy the weekend, definitely. So I can take the tie off now. It's officially my weekend. See, it's a real tie. I actually tied it. All right. Thank you, everyone. Take care. I test drove an electric motorcycle, and the problem that I had with it, honestly, is I had 3 people step off the curb right in front of me. Because they don't hear you, they don't see you. It's bad enough. Yeah, I test drove a 0. And I will not buy one just because of that. It was great. It was a fun bike. But when I'm in town, I had people step right in front of me. Nobody even knew I was there. So it's way too dangerous. I can't do it. So anyway. All right. Take care, everybody. See ya. I'm out of here.